There is no single reason why a company's stock is underpriced. You often see a company performing at its peak, and suddenly, it struggles to keep its head above water. There is something that the public doesn't understand, and that is the fact that a company running a successful business can be affected by bad news. Many companies face bad news, and they become negatively affected. In that regard, it is the company's stock price that suffers from the loss. The magnitude of the information determines the extent of damage that will be done to the company. Therefore, as a successful investor, your role is to analyze the news and do some calculations. The calculation will help you decide if it is safe for you to invest in such a company. Value investing may be a fundamental investment strategy, but it does not erase the risk involved. It may be highly profitable if you analyze the company appropriately, which is why successful investors use some parameters to reach their investment decisions. One such parameter is the margin of safety. When valuing a stock, you must leave some room for mistakes, errors. With this, you can benefit from your investment in the long run because there will be a subsequent price appreciation. It is the responsibility of an investor to be able to differentiate between a current undervalued stock that can rise in the future and an undervalued stock that is never going to generate revenue in the future. Value investing is open to everyone. It is not limited to a particular set of people. However, you need to be a patient investor to benefit from this investment strategy. All the short-term market fluctuations should not divert your attention from the long-term gain. That being said, ABV Inc. stock, ABBV, is one of the stocks we are considering investing in using the value investing strategy. In terms of healthcare stocks, the company is one of the largest globally. The company's share has fallen recently after achieving some highs since April 2022. The company's market cap is presently over $250 billion. Their service cuts across eye care, oncology, and other therapeutic areas that you can think of. Therefore, when considering the future, the company will likely continue to thrive. For instance, the company ended the month of June with a net revenue of $14.6 billion increase. Furthermore, they also have some successful products. Skyrizi and Rinvoq are products that bring a good return for the company. Also, the company is likely to increase its dividend over the years. This is a very attractive offer for value investors who can buy and hold stock for a long time. The company's stock is not a cheap buy, but its valuation is close to being a fair deal. It is suitable for me to say that the company's stock is showing some good strength that is worth considering. This is a positive sign because when other businesses in the healthcare sector are struggling, the company is doing well above average. Another vital stock to consider is Berkshire Hathaway Incorporated. BIKB. The stock is worth being kept under close watch. This firm belongs to the most significant investor of all time, Warren Buffett. The company owns some of America's famous firms, such as Geico and Fruit of the Loom. And according to MarketSmith analysis, the company's stock is below a buy point of 362.20. Although since late 2017, the stock has been lagging behind the S&P 500 index. The stock can be added to one's portfolio, or to be on the safer side, you can add it to your watch list and do your research. The company has so many diversifications and offers better future returns. Every stock has some factors that can affect its relative performance. It will be a good idea to review the likely factors affecting Berkshire Hathaway. Amongst the many things to consider, you may decide to review the changes in the market earnings. The present value of the company's stock may not be used to determine the future earnings of the company thoroughly. The company was underperforming before Warren Buffett bought it in 1964, and since then, the company has been successful, with a market cap of about $660 billion. In addition, it has one of the best rankings among other U.S. companies. It was known as a textile company, but it is now involved in many businesses, which is why it has various subsidiaries. Logically considering the company's future, it is only correct to say that it is worth adding to one's portfolio. However, this does not erase the aspect of carrying out more comprehensive research before deciding. Another company that has one of the most searched stocks, according to Zacks, is ExxonMobil, XOM. The company deals in oil and natural gas. Therefore, this might be something that you want to look into its long-term performance. Many investors are curious about the stock's future direction. In terms of dividend payment, ExxonMobil has an outstanding record. Even though companies like Walt Disney and more cut their dividend over time, some oil and gas companies even go as far as suspending it. ExxonMobil is known to continue payment of dividends over a long period till date. Globally, there is going to be a need for oil for as many decades as you can think of. This is one of the fundamental reasons why successful investors buy stocks of oil companies. Aside from oil and gas, the company is working on significant projects. This includes strategies for climate change mitigation. For the company to have the resources to pursue carbon capture and storage, it has a firm footing. In addition, they are also considering possible ways to develop biofuels from plants and algae. This makes the company also to be involved in the energy sector, and they are likely to produce strong earnings even in the future. One of the places that they gain their strong earnings is through the higher prices of oil. Therefore, considering the company's stock may be one of the most imaginative things to do as an investor. Amidst the rising fear of a recession or an economic downturn, Google Alphabet Inc., Google, stock seems to be a good buy. Many people know of this company because of its role in our daily activities. The company has great strength in terms of artificial intelligence and digital advertising. The company's stock may face some irregularity, but this does not make it a bad investment option. The company's post-earnings pullback indicates that this is a good buying opportunity. A quick flashback to the 2020 pandemic, many businesses suffered a significant setback. Google's advertising business also had its fair share of setbacks. It has low sales compared to previous years. However, they were able to make a recovery in the following year. Not many businesses can bounce back to their feet till date. According to the company's CEO, Sundar Pichai, the company has plans to moderate its operating expenses in 2023. If the company should cut costs where needed, it is also a good sign. There won't be the existence of projects that are not profitable. Many financial analysts are expecting the company's revenue to rise to the table of 12%. The company may go through so many difficult periods, but just like in the past, they are most likely to survive. Let's recall that the company was founded in 1998. For potential value investors, it is a good thing to consider the company stock. The last stock to be added to my watch list is Qualcomm, QCOM. The company deals with tech, and many investors are pretty confused. They are having a tough time deciding whether to buy the company stock right now or if they should wait for a better time. However, there is no better buying time than now. The company stock may be a good investment because of its potential. The company's stock performance has worsened this year. Notwithstanding, the company reported that its total revenue increased over the year. Finally, value stocks are cheap, and they are classified under low-risk investment. However, the exciting aspect of value investing is that it is a long-term investment strategy. Highly successful investors use this strategy. Warren Buffett is a typical example of such people. Successful investors understand that just because a stock is undervalued now doesn't mean it will continue to be so. The stock may be trading for a lower price presently, which is lower than its intrinsic value, which makes that investment an attractive one. As a long-term investor, it is okay for you to make such an investment, but before then, don't fail to carry out detailed research. Don't forget that this idea is based on buying low and selling when the price is high. We hope you were able to learn something new from today's video. Before you go, don't fail to leave your thoughts in the comment section, and like this video. And that's it for today's video. Please hit the like and subscribe button and click the notification bell to be updated every time we upload new videos. Thank you for watching, and until next time, always stay very motivated. See you again in our next video.